Okay, hi everyone. So a very good afternoon to all of you, and thanks for tuning in during your precious lunch time to join this webinar to learn more about CFDs, which also stands for Contracts for Differences. So without further ado, let us begin. So during this presentation, do feel free to leave any questions in the Q&A section so that I can address them afterwards. So this will be the content outline for today's webinar. So what are CFDs? CFD is an agreement between two parties to settle the differences between the opening and closing prices of the contract. So they are what we call the traded OTC, meaning over the counter. So they do not trade on the exchanges. So in this case, it will just be a contract between you and us, PhillipCapital. CFDs are derivative products and their prices track the underlying asset closely, allowing you to participate in the price movement of underlying product without actually owning the assets. So I know you just started, but by now you must be wondering, so is there any difference between CFD and stocks, and which should you trade? So I will say that will actually depends on your objective. Here, I'll highlight a few differences between CFD and stocks. So firstly, ownership of assets. For stocks, you have ownership over the asset, but for CFD, you do not actually own the asset. So this means that you are not entitled to any voting rights if you trade CFD. Secondly, ability to short. So stock is only one directional, means that you can only buy, but CFD is bi-directional, meaning that you can either buy or short sell. Hence, CFD is not restricted by the market direction, and this will be good for you because you are able to take advantage of the rising market by taking a long position or shorting in the falling market. And this is applicable to all the products that we are offering, be it equities, commodities, index of FX. So here I would like to add that you can actually short Singapore equities intraday, but beyond that, you have to utilize the SBL facility, which also stands for shares borrowing and lending, to borrow the shares that you have sold otherwise, or you'll be subjected to SGX buy-in. So for those who have done that, you'll know that that is actually very expensive, which we all don't want to pay the extra charges. So CFD will be useful in this case, as it can give you greater flexibility, as you will be able to short without having to borrow shares. Thirdly, leverage for cash equities. So CFDs are leverage products. You only need to put up a certain percentage of the total contract value in order to establish and maintain a position. So this percentage varies for different counters, which you can get this information when you open a CFD order ticket on our platform. This will give you the advantage of enhancing your portfolio with the same amount of money, since trading stocks will require to put out the full contract value in order to open a position. So lastly, finance charges. So as you do not have to put out the full amount for the contract, this means that PhillipCapital is actually loaning you an amount to establish and maintain that position. Hence, these positions will be subjected to finance charges if you hold them overnight. So I'll further elaborate on this with an example later in the slides. So there are many advantages of CFDs. As mentioned earlier, you can use CFDs to establish a short position. It gives you leverage. There are multiple asset classes that you can trade, and CFDs can be used to hedge against losses in your existing portfolio. Another advantage that is not included in the slides is that there are no expiry dates for the contracts, so you can hold the short position for as long as you like without having to borrow shares or be subjected to SGX buy-in. Okay, now I'd like to explain more about leverage, which is also known as margin trading. We learned that CFDs are leverage products. You only have to put a certain amount of deposit to trade larger positions. Here, a relatively small market movement can have a proportionate larger impact on your deposit. This means that leverage can actually amplify both your returns and losses, as there's a possibility that you can lose your entire deposit or even more should the market move against your favor. Now let me show you an example. So the margin required to buy Amazon share CFD is 10%. So assuming that the price is $3,161, the value of 10 Amazon cash equities will be $31,161 in this case. So instead of putting up the full amount to buy 10 Amazon cash equities, you only have to put up $3,161 to buy 10 Amazon share CFD. So note that this amount is actually equivalent to just buying one Amazon share. This also translates to 10 times leverage. So up till now, I have only been highlighting all the goodness that comes along with trading CFD. But the losses arising from a CFD trade can also be unsettling. So the table below illustrates the difference between trading CFD and stock. From the table, we can see that for the same contract value, the ROE actually differs from trading stocks and CFD. So let us take a look at scenario 1. When there's a profit, the ROE for the CFD position is 50% versus a mere 5% for the equity position. However, look at scenario 2 when there's a loss. The ROE for the CFD position is negative 50% versus negative 5% for the equity position. So this actually illustrates to us the danger of trading CFDs. In the event when the market goes against your favor, it can result in huge losses. So therefore, you learn that it is actually very important to manage your own risk and assess if CFD trading is for you. From our own experience, retailers can actually lose a lot when trading CFDs. So it's important to exercise discipline and ensure that you are equipped with the right tools. This is also what we at PhillipCFD are committed to do, to educate our clients by providing educational materials and webinars. And this can all be found on our website. So once again, I would like to reiterate that leverage is a double-edged sword. Even though it can increase your returns, it can also amplify your losses. So please exercise care when you are trading using leverage, and do not hesitate to speak to your trading rep or ask for more information on CFDs. So next, we'll move on to different products offered by PhillipCFD. So firstly is our equity CFDs. So they actually mirrors the cash market price movements and no additional spread, meaning that the price quoted for equity CFD is the same as the cash equity market, as shown in the screenshot here, where we can see that the price for UOB is the same for all products. The margin required varies for different counters, but the lowest it can go is at 10%. So we offer a huge range of equity CFDs from 8 global stock markets, with over 1,500 counters in both Singapore and US markets. And these counters can all be found on our platform, so you can later, maybe if there is time, I can show you how it looks like on Poems. So next is DMA CFDs. DMA here stands for Direct Market Access, and this is only available for the Singapore equities market. DMA CFD provides investors with direct access to the exchange, so clients will be able to enjoy the various features, such as taking part in the pre-opening and pre-closing sessions, participating in the market liquidity and order book of the exchange. Orders are also done based on the last done price, based on the price time priority. So this slide highlights the main differences between DMA and CFD. So first, we can see that for CFD, your orders may or may not be reflected on the exchange, while for DMA, your orders are routed to the exchange, so it will appear on the order book. Secondly, for CFD, orders are done based on the bid and ask prices quoted. On the other hand, for DMA, orders are done based on the last done price according to price time priority, which is similar to your equities trade. Lastly, the commission rate for CFD is lower than DMA. So if cost is a concern for you, then CFD may be a better option as compared to DMA. So I know here some point you might have also actually which is better for you between CFD or DMA. So the choice between these two will really depends on a few factors. So let's say if you are used to trading the cash equity markets and you want to try CFD but you are still a bit wary, maybe you can start with DMA first. Or if you actively participate in the pre-open and pre-closing session, then you have to choose DMA for this case. And if you do not like the idea that you are trading against Phillip CFD for various reasons, then DMA as well, since you are trading on the exchange with other parties that are trading on the exchange as well. Or if your contract size is quite huge and you know what you want, which is to buy on the ask price and selling on the bid price, then CFD will be maybe a better option for you. So something I'd like to add on here is that since we offer both CFD and DMA for Singapore equities, do take note that a CFD order cannot be used to close out a DMA position and vice versa, since they are a different type of contract. This also means that you have the flexibility to open opposing positions on the same Singapore counter in the same CFD account, thus hedging your position. So I'll explain more about hedging later on. So another product that we are offering is the commodity CFD. We offer products on the most frequently traded commodities, which I think most of you have heard of or even trade yourself, which is the gold and silver. And we also recently launched our UK and US oil products in March. So stay tuned to the end to find out the promotion that we are offering for trading our oil products. The margin can go as low as 20%, and this is for clients who are interested to add commodities to your portfolio, but at the same time who do not want a huge exposure to this product. You can also consider using our mini contracts to trade or diversify your portfolio. We have mini contracts for both the gold and the UK and US oil. We also offer world indices CFD on major indices such as the S&P 500, the Hong Kong index, and many more, which if time permits, I will show you on the website later as well. Yeah, so the margin can go as low as 5%. And we also offer micro indices for some of the major index. So for instance, you can see on the bottom right-hand side, the US S&P 500 US dollar 1 and the US Tech 100 US dollar 1 contract. So these micro indices are offered with the same spread and at a lower commission. So this product can provide huge advantage to clients who like to invest in many counters but have limited capital. So our index are either cash derived or cash correlating. So the cash derived indices CFDs means that they are derived directly from the underlying cash index, but the price of the cash correlating indices CFDs may differ from the underlying cash index, but do rest assured that they are still correlated to the underlying cash index. So indices CFDs are extremely useful contracts to add to your portfolio, as you are exposed to the stock market performance without having to buy the individual counters that make up the index. The chart on the slide here shows how you can take advantage of the indices movement by buying a contract when you have a bullish view and selling off when the price rises. So similarly, if you have a bearish view, you can also short at a higher price and buy back when the price is in your favor, such that you can make a profit from this. So let's take a look at the contract specifications of an index CFD to understand more about the product. So what you can see here is the contract specifications of our Straits Time Index SGD5 CFD. So from the name itself, we can identify that the value of one index point is $5, meaning that 1 point increase will result in a $5 increase in your contract value. The initial margin and maintenance margin for this product is the same at 5%, and the trading hours are stated, and the target spread of this product is 3.6 points. So this means that we aim to keep the spread of the product at 3.6 points between the bid and the ask price. But do take note that this is subjected to variation and may not hold true, especially in volatile market conditions and out of trading hours. So here I only show like example for the STI Straits Times Index, but it also varies for the different indices contracts that we are offering. So suppose you buy one contract of STI 5 CFD at 3,300. The contract value here will be 3,300 multiplied by the value per point, which is $5 in this case, amounting to $16,500. And do realize that you only need $825 to gain exposure to the Singapore stock market performance. So this is very ideal for people who have limited capital and do not want to be exposed to a single counter only. Next will be our FX CFDs. So this is the latest addition to our suite of products. Do you know that FX is one of the most traded instruments in the world? 22nd August 2019 marks the birth of PhillipFX CFDs. At that point, we were only offering the G7 currencies and SGD. But right now, we're actually offering more than 30 major FX pairs. We offer FX trading in mini sizes at a contract size of $10,000 in the base currency of the pair. And clients can enjoy 20 times leverage for this product. Now let me dive deeper into the basics of FX CFD for our audience who may not be familiar with this product. So in an FX pair, we'll have a base currency and a term currency. So let's take a look at this example, which we are looking at pounds versus USD. So the base currency here is the pounds and term currency is the United States dollars. Now when we enter a buy or sell transaction, we'll always refer to the base currency and the opposite transaction will take place in the term currency. Yeah, so what does this actually mean is such that if we are buying, let's say we are buying Great Britain pounds USD, we are actually buying pounds by selling USD. And this is how we'll understand the quote. So when pounds USD is quoting at $1.30, this means that 1 pound is equivalent to $1.30 US. Do note that your profit and losses will always be reflected in the term currency, which for this example will be the United States dollars. Next, I'll introduce something that is unique to trading Forex, and that is swap points. So swap points arises from the difference in the interest rate between the currencies bought and sold. So for this example, it will be the difference between pounds and the United States dollars. Now, when you trade FX, you will earn an interest on the currency bought and pay the interest on the currency sold. And when one holds a FX CFD position past overnight being 5 or 6 a.m. Singapore time, depending on whether it is daylight savings, the FX position will gain or lose swap points. And this gain or loss will be credited or debited from your CFD account as a swap point adjustment. So now you realize that the advantage of trading FX is that aside from profiting from price appreciation, there's also a possibility of gaining swap points from your positions. So these are just the basics that I've shared. So if you'd like to know more about FX trading, you can actually find the recorded webinar on our website that is done by my colleague. Next, we'll move on to the mechanics of trading CFD. Now, CFD orders are done based on the prevailing bid or ask prices. So when clients submit a buy order, the buy order will only be done when the price submitted is higher or equal to the prevailing ask price. Similarly, a sell order will only be done when the price submitted is lower or equal to the prevailing bid price. Hence, for CFD orders, we only focus on the bid and ask price. So this is the process flow of your CFD order. So it's like we place a trade and then there will be pre-execution checks on the trades to ensure that there are some requirements are met before routing the order to our hedging desk for processing and the matching. So if you have any questions, do feel free to leave it in the Q&A section or reach out to your trading rep. Next, I will show the order execution for DMA CFDs. Now, since the order is routed to the exchange, you'll be able to see your order on the exchange order book. So looking at the screen, right, you can see that this is the market depth before a DMA CFD trade is submitted. So let's focus on this like 48,000 and it at 0.85. So suppose you submit a DMA CFD buy order at 0.85 for 1,000 shares CFD, DMA CFD, you will see that the market depth now has been updated, where the buying price of 0.85 has increased by 1,000 to 49,000. Now, of course, all these transactions comes at a cost. So the first cost that we are all familiar with will be the commission charges. Commission is charged on both the opening and closing of CFD positions, just like your normal equities trade. In this case, the amount charged will be based on the total contract value. So if you remember the Amazon example earlier, you will be charged based on the 10 Amazon share CFD that contract size, rather than just the 3,161, which is your margin that is put up. So the advantage here is that CFD trades, equity CFD trades, they are done on the same day for the same counter and contract type will be amalgamated. So this feature is extremely beneficial for clients who do multiple small trades within the day, whereby those trades fall below the minimum commission chargeable. Here we'll sum, like let's just say if you buy 100 DBS shares twice within that day, so we actually sum up the 100, so 200, multiply by the price that for each order, then multiply by the percentage to get the commission, and whichever is, whether that amount is smaller or the minimum com of 25 is smaller, we'll use that for the commission figure. Yeah. So for commodities and world indices CFD, they are charged on a per contract basis. And for FX CFD trades, there are no commission. So another cost that comes with CFD transactions are the finance charges. So finance charges are charged to overnight positions, meaning that if you buy, let's say you buy a DBS position right now and you do not close by the end of the Singapore market close today, then this is an overnight position already. And this is accrued on a daily basis and will only be realized upon the contract rollover or the liquidation of the position. These charges actually reflect the cost of borrowing so as to allow you to open a leverage trade. This means that there are no finance charges for positions open and closed within the same trading day. So this is ideal for those traders out there. FX positions are also not subjected to finance charges, but as mentioned earlier, they will be subjected to the swap point adjustments, which may be a debit or credit, depending on the position. So now I'll illustrate the example of how to calculate how the finance charge is calculated. So the daily financing charges are calculated based on the formula you see over here, which is the total market value of your CFD positions multiplied by the finance rate per annum for the CFD contract, divided by 365. So here I'd like to share that the finance charge for long is usually 4.5%, but if you want to get the exact figure for that particular counter, this is also shown as the show on the order ticket as well. So for example, if a client opened a long CFD position on Amazon and closed the position on the third day, so this is how the calculation will be like. So let's say that the market value for day one is $31,000 and day two is $35,000 respectively. To find the total finance cost of the contract, we will have to find out the finance charge on day one and day two, which is $3.40 and $3.84 respectively. So here you notice that there's no finance charge for the third day since you already closed that position on the third day itself. Now the total finance cost amounts to $7.24. Since CFDs are traded on margin, there's something called a margin call that you may be subjected to. Margin call is issued when the equity balance, which is the total asset in your CFD account, falls below the required maintenance margin. Usually, this will happen in two situations. First situation is when the market goes against your favor, such that your unrealized P&L is so huge that it depletes the available cash in your account. And the second situation is when the market goes in your favor, such that the maintenance margin required for that position is so huge that you do not have sufficient cash in your account to support the position. So usually you'll be happier in the second situation, since that means that you're earning profits. That's why you need to top up. Okay, now the equity balance and maintenance margin figures will be calculated using the previous day closing prices. And client will have 2 business days, up to 3 p.m. on the second day, to fulfill the margin call. Now you see this exception in bold is when your equity balance has fallen below 5% of the market value of your portfolio. Then you will be directly issued with a day 2 margin call, such that you have to fulfill the margin call by 3 p.m. on the day itself. So when clients receive a margin call, they can either deposit funds or liquidate sufficient positions to satisfy the margin call, so as to prevent a forced liquidation of their positions. So now you must be wondering, what can you use CFDs for? Yeah, so you can use CFDs for trading. CFDs are suitable for clients who have varying needs. Clients can use CFDs for long-term investments with small upfront capital. It can also be used for scalping for clients who want to take advantage of short-term price movement with enlarged trading power. Lastly, it can also be utilized for sophisticated trading strategies such as arbitrage. So another use of CFDs is hedging, which I've mentioned multiple times earlier. Now, how it works is that clients can hold opposing positions concurrently to protect against adverse price movements, thus protecting their long-term positions from short-term volatility. I'll demonstrate how you can use CFDs to hedge your position. So let's look at the chart over here. So assume that you have a strong conviction that the price of ABC cash equities will rise and would like to keep it for your kids in the future. You then buy one lot of ABC cash equities at $25 on 3rd December, which is this long green bar over here. But the price tumbled down afterwards. So what can you do assuming that it's a bearish market at that moment? Now I think it's safe to say that at the point of time, our first reaction will always to observe and hope for a reversal. However, the prices kept falling and you panicked and decided to sell it off at a loss at $23. So here I'd like to say that the figures here are just for example and may not be indicative of the actual figures. Now the losses resulted from the difference in the price movement here will be $2,000. And the cost will be the commission for both opening and closing trades, which amounts to $128.40. And the exchange fees payable is $19.20. Now the net loss resulting from this position is $2,147.60. But what if, just what if, I tell you now that you can actually take advantage of this bearish movement and make a profit out of it? Sounds attractive to you, right? So instead of panic selling, you actually have another option, which is to hedge by establishing an opposing position in equity CFD or the World Indices CFD. Here, I'd like to bring up that indices will only be a good hedge when you have a portfolio of index component stocks, which will usually be the blue chip companies. Now, assuming that ABC is a STI component stock, you can choose to either hedge fully by establishing an opposing position in the same counter with the same quantity, or hedge partially by establishing a position in a correlated instrument like the STI CFD. So first I'll illustrate scenario 1 where you choose to hedge fully with equity CFD. So here you can short sell ABC at $25 and buy it back at $23. So the gain from the price differential will be $2,000 and the cost of this transaction will be $155.74 for both the commission and finance charges. So the net profit that you can make from this trade is $1,844.26. On the other hand, let's illustrate scenario 2, whereby you choose to hedge with indices CFD. So to hedge your position, you can short sell one contract of STI 5 CFD at $3,160 on 3rd December, which is here, and buy back at $2,994 on 4th Jan, which is here. So the gain from this price differential will be $830, and the cost of this transaction amounts to $64.12. So in this case, the net profit from this transaction is $765.88. Now, from these two examples, we can conclude that it's actually better to hedge out your positions, especially when there are signs of strong reversal, such that you can make some profit even when prices are falling, without falling prey to your emotions and exercise panic selling. Now, so for existing Poems clients who are interested to use CFDs but do not have a CFD account yet, you can open a CFD account easily now by logging onto the platform, go to the account management tab, and then go straight to the CFD tab and look for the online account opening. For new clients, you may visit poems.com.sg to open a new account. And do remember to select the CFD facility before proceeding with your application. Now we are pleased to announce that the clients can now open a new CFD account within minutes. So very ideal for clients who want to trade based on the current price. But this is also subject to the requirements such as filling out the necessary forms and funding your account as well. For funding wise, you can either do an internal transfer from your stock account to your CFD account or top up directly from your bank. For internal transfer, you can go to account management, go to the stocks tab, and go straight to the online forms. So make sure you are at the withdrawal form before inputting the amount that you wish to transfer. And here, make sure that it is transferred into the account with your account number followed by the bracket CFD. For funding directly from your bank, we will recommend Pay Now as it is the fastest method available. For direct crediting into your CFD account, do note that you have to add CFD after your 7 digits Poems account number. Otherwise, it will just go to the stock account and you have to do an internal transfer as demonstrated earlier. Now to the part where majority of you are probably most curious about, the promotions that we are offering. So first we have the oil promotion, whereby you can get $100 petrol voucher by trading 1,000 oil contracts with us. So here you can actually scan the QR code to learn more about the promotion. Okay, next I'll move on to the next promotion. So we also have our micro Hong Kong equity CFD contracts, whereby you can trade Hong Kong equity CFD from just 1 unit rather than the broad lot size, which a lot of us may not be able to afford because sometimes the stock price is very high, then you have to buy the minimum size, which may be, the amount may be quite huge. So this will be ideal for clients who wants to try the Hong Kong market or who have limited capital. We are currently offering this for about 50 counters and are looking to expand to offer for more counters. So if you guys have any counters you'd like to add to the list, you can suggest to us so that we can consider it as well. Yeah, so here we have the QR code as well. You can scan it to learn more about this promotion. Okay, and the next promotion that we have is a cash rebate of up to $88. And this is available not just for the new clients, but also existing clients who did not trade CFDs during the period specified. So you can hop onto our website to learn more about all these promotions that we are having. And this is also the QR code for the 88 promo. Okay, with that, I've come to the end of my sharing. I hope that all of you will be able to walk away with more knowledge of CFDs and are thinking of how to use CFDs to boost your portfolio, instead of sticking to a conventional way of just buying low and selling high. So if you require more assistance, you can either call in to us at this number or drop us an email at cfd@phillip.com.sg. Now I'll be taking any questions that you might have, so you can leave your questions that you want me to address on the chat. Okay, for the first question by Mr. Tan, which he mentioned that you want to short but encounter the rejection message. So usually this message is when we do not have script available for that counter itself. That's why the sell order is rejected. So, but because I'm not sure which counter that is submitted for this, so maybe you can call in, call in at this number so that we can take a look at that order and properly advise you lah. Okay. Okay, and next is for Sharon's question, which is how much initial margin required to deposit for a new CFD account, right? So actually, we do not have a minimum amount that you need to deposit with us. But what I'll say is that just ensure that you have sufficient money to that's required for the margin that you want for that particular position. Yeah. Okay, for the question on how to calculate interest, maybe let me go back to my slide. Give me a Okay, so the interest calculator is actually based on the market value at the end of the day. So how much to calculate? We have to wait for the market to close first to get the closing price. So let's see this example, right, where the market value for day one is $31,000. Yeah, so the finance cost for the Amazon, let's just say is at 4%, right? So you take 31,000 multiply by 4%, but the 4% is a per annum figure. So you just 31,000 times 4%, then divide by 365. So that will be the interest for that day itself. And this amount will differ because the next day the closing price will also differ. So you have to calculate daily. Okay, for Royston, since you joined late, right, you can actually email us or call in to for your questions as well. Okay, so for the question on whether the margin of a CFD contract be auto recalculated if you have some cash in your account to offset. So this margin, right, is actually fixed. So it's at the margin percentage that we have set previously. So even if you have additional cash, right, it will still be fixed at that. Let's just say 5%. Okay, so for the question on why CFD short option is not available for some counters like Top Glove and DBS. So for this, you can actually call in so that we can check on our back end why is it disabled. Next question on the if the trade is in US dollar, do we first need US dollar in the account to trade? So the answer is no. So as long as you have like whichever currency, as long as that amount, the available cash is sufficient for you to open the US dollar position, then you will be able to open it. But however, because ultimately the positions will still take place in the US dollar, right? So advise you to actually convert the available cash to US dollar. Otherwise, you'll incur something we call the ledger deficit interest, which is when your that currency ledger is in negative, right? There will be an interest amount charged to it. So it's always better if it's okay with you to actually convert the currency that you need for the trade before opening that position. Okay, so for the question on what is the minimum amount to trade crude oil CFD? So for one quantity of crude oil CFD, assuming it's the mini contract, right, which is just $60. Assuming it's $60 and the margin required is 20%. So here you only need $12 to open one quantity of the crude oil CFD. Okay, so for the question on the can I open paper trade to familiarize with the trading, the charges will be reflected in the paper trade. So currently we do not have a demo account for CFD trading yet. So yeah, there's no paper trade that you can try out. So sorry about this. For the what is the difference between the future indices CFD and the cash indices CFD, right? So the main difference will be that the fair value for these two will be different. But for more in-depth information, I will recommend you to call in because we don't have time here for to explain this right now. Okay, for the question on can advise some mini indices names, for example, Hong Kong indices. So for now, we do not have a contract for the Hong Kong indices yet, but there are plans in the future to actually dive this down. So you can stay tuned for this. But right now, we are offering the for the US S&P 500 and the US Tech 100. So these products are actually side by side. So make sure when you click on the order, right, make sure it's the USD one. That will be the mini one. Otherwise, it will be the USD $5 one. Next to the question on what's the difference between the CFD and options trading, right? So these two are different products in the first place. So I will advise you to actually contact your trading rep to know more about the differences and let him know which one will be more suitable for you. Okay, for the com rate for DMA and CFD, right? So firstly, this will also be split between the STI component stocks and the non-STI component stocks. So for CFD, for STI component stock, right, it will be at 0.128%, and the non-STI component stock will be at 0.18%. For DMA, the STI component stock is at 0.2%, and the non-STI component stock will be at 0.25%. So the minimum commission for the DMA and CFD is same as the minimum of SGD 25, USD 18. So for currency conversion, what rate are you using? Spot rate or your system rate? So for our currency conversion, right, there will be a spread to this FX rate, but now it's very transparent, so you can go straight to the Buoyant's platform, where you can see that what's the rate that you're converting your currencies at. For the do I have to be an accredited investor to access for DMA? The answer is no. for the what is the minimum amount to trade S&P 500 mini CFD? So assuming, okay, currently the price now is to buy at 4143.25. So the amount that you need is about approximately 208 USD to open one S&P 500 mini CFD contract. The next question on the for DMA, if we key in before market open, will the order enter the exchange during the pre-opening period? So the answer is yes. It's like trading your normal equities. So you can submit at that time and you'll be valid for the day until the market close. Yeah. Okay, next on the question on will you be able to illustrate on top up situation in the dollar amount? So for this right, will actually the system will actually send you an email on that day itself if you have a day one or day two margin call, and in the email itself it will actually state how much you need to top up. So you can just follow that amount and act accordingly whether to sell your position or to top up. Okay, I have a question on Facebook when someone is asking to explain again on hedging. So rather than I explain again, maybe you can consider calling in so that I can explain more in depth to you personally so that the rest can ask their questions as well. Okay, seems like there are no other questions. I hope I did not miss out any. And if you still have any doubts that you have, you can just call in to us at this number here, over here. And for with that, I'd like to thank you guys for the time and the questions that you have posted. And anything else, just call in or email. Yeah, thank you and hope you have a nice day. Bye.